Good afternoon, everybody, and welcome to another session of the OIC's webinar series. We're very, very happy to welcome Dan Kerrigan, President of the NASDAQ Futures Exchange. Dan has been a recent OIC presenter. He's presented both live and online webinars for us. Dan always has terrific insight into options trading and specifically his favorite strategy, the cash secured put. So we're very excited to have Dan give us his knowledge and expertise on this particular strategy. Dan, go ahead and take it away, sir.
Thanks, Mark, and greetings to all fellow retail investors. And without question, this is my favorite strategy, specifically as a fellow retail investor. So as the title states, cash secured puts, getting assigned on the decline. Practically, when you look at options, there's a lot of combinations that come at you, and it's always a challenge to find the strategy that makes sense both from a short-term and long-term horizon. But I think when you look at in terms of option strategies, it comes back to what I call simple human nature. And it's framed in one sentence. And it's essentially, do you like buying stuff on sale? I mean, I know I do. So if you're one that likes to buy a product below the listed price, then this strategy is well suited for you. We'll get into the nuances of the cash secured put. And without question, those of you who are options approved for your online retail brokerage accounts, this strategy is fully available at your fingertips for a point and click. But before we get started, let's take just a minute and take a look and review the disclaimer. It's important to recognize that options involve risk and are not suitable for everyone. And at the time that you became options approved from your broker, likely they sent you a booklet in the mail called The Characteristics and Risk of Standardized Options. But if somehow that made it into the recycling bin or wasn't on your top 10 reading list, we encourage you to obtain another copy, a soft copy, simply by going to the website optionseducation.org. And of course, your broker will always have it available as well. But in terms of today's presentation, we've gone to links to simplify the computations in the examples, and therefore no commissions, fees, or margin, interest and taxes have not been included. So this is really just raw trading strategy, dollar in, dollar out. And of course, the strategies discussed today, including all of the examples using actual securities and price data, are really just for illustrative and educational purposes. Nothing here in today should be construed as an endorsement, recommendation, or solicitation to buy or sell a security of any type. So with that behind us, let's just take a few minutes to talk about a great resource for you as a retail investor looking at or might have quite a bit of experience with options trading. And that is the Options Industry Council, affectionately known as OIC. We're not brokers, we're not advisors, we are educators. So with that in mind, we offer a free and unbiased professional options education program that is available at your fingertips 24/7. All you need to do is go to the website optionseducation.org. And you'll have a chance to see this presentation. You're also going to have a chance to look at a lot of different strategies. I think today's view is really for someone who is new to options trading or someone who kind of might be a little bit mixed up in terms of using put strategies versus call strategies. But in any sense, going to optionseducation.org will help you on your educational path. Lodged at the website, of course, are the online courses, all kinds of podcasts, videos, and seminars. And we also pride ourselves on not leaving you hanging when it comes to the educational process because we know you're going to probably have questions that are highly specific to your interests, to your strategies. And you can always send those questions to the email address listed here on this slide, options@theocc.com. And I have good news for you. Your questions will not go into a dark hole. There are competent staff on call looking and monitoring the inbox, and we'll be back to you in a very short time. So let's move on. OIC is made up of 5 U.S. listed options exchange groups. A lot of these names that you see probably are recognized from the trade of CBOE, NASDAQ, BOX, NYSE, and MIAX options. So how do you know what goes on with your order, with your broker? Where's it going with these 5 different exchange operators, which have multiple options exchanges? Well, the good news here is that as an option trader or option investor, your option order will automatically get sent by your broker to the exchange which has the best bid or best offer. And then if that exchange can fill it at a better price, it will link to another exchange. So one of the hallmarks of the options industry not only is the great liquidity, but it's what we call the national market system of connectivity, that is interconnectivity by all the exchanges to properly represent your interests, therefore affording you the wherewithal when you want to sell, going to that best bid to hit. And of course, when you're looking to buy, going to that best offer to lift. So with that in mind, all the exchange operators invest time and effort in the educational process with OIC. And our goal is to bring smart ideas to the table for you to look and continue your path on education. So with that in mind, let's move on and take a look at the options industry in general. Now, for those of you who are new to options, you're probably more in line with hearing, as you drive around in your car each day, the update for the markets. Here's how the S&P 500 did today, the Dow Jones Industrial Average did today, the NASDAQ 100 did today. All of these indexes giving you an idea of market direction up or down. And also, likely in some of these broadcasts will say today's trading was marked by heavy volume or light volume, or they'll give a number, in the billions of shares. Well, that's okay and good and well, but it doesn't really tell you much of a story because there's so many individual stocks. But just as that's the case in the options industry, we have options listed on almost all stocks that are available for trading, numbering in the thousands of stocks. And that very wherewithal to trade options has been expressed since 1973. But as you can see from the chart, the story of the options industry really kind of started out as a trickle. In fact, options only began with call options back in 73, and it wasn't until a year later that they added puts. You can see the chart moving on through the 80s and 90s, kind of had like a meek or a timid path. But of course, as we went through the mid-90s, we started to take off. And for all of you hockey fans out there, you can see this is a true hockey stick picture of growth. And in the industry, we like to say options are the perfect tool. And the reason for that is really very simple. Options are the perfect tool for 2 reasons. 1, risk management, and 2, trading opportunity. And likely, these 2 reasons why are the reason why you are here at the webinar today. So you can see the year 2018 barn burner just reaching 5 billion options for the first time in 1 year. So obviously a deep and liquid market, a robust national market system to meet your investor needs. So today's presentation of the cash secured puts, we've gone through an agenda to really take you from the very basics of what it means to execute a short put trade, and also to talk about the motivation for you as a retail investor as to why you would enter into a cash secured put trade. But really importantly, I know a lot of focus in terms of the brokerage industry is always on one side of the R, which we call the reward side. But I think it's just as important, maybe more important, to focus on the other R side, and that is the risk. specifically the risk of today's strategy. We'll go through a couple examples, one of just a simple stock and one of an ETF. So it doesn't matter if you're in tune to stock trading, that's your idea of the path to investment success, or you're really one that wants to utilize your views, your strategies in the ETF space. We'll cover both of them today. And I am confident you will come away with a very simple understanding of how this strategy might be applicable to your reward and risk profile. And we'll also touch on a critical term or an attribute to the options industry called moneyness. And our goal is not only to talk about strategy today, but also to give you some ideas about some of the terminology, which then you can leverage as you go further with other strategies at optionseducation.org. And then, of course, what do you do when you get a position on as a result of an option, whether it's an underlying stock or an underlying ETF? We'll go into that as well. So without further ado, let's get into the heart of today's presentation, that is the cash secured put, and talk about the basics. Now, in the first instance, the assumption here is that investors know the difference between a put and a call. We often find new entrants to the option space have an easier time, frankly, of calls because they see it as a product synonymous with owning a share of stock, as in it increases in value as the stock increases in value. But that's just from the long side, the buy side. What happens when you flip that idea to puts? Well, holding a long put is the right but not the obligation to sell a stock. So the right but not the obligation to sell a stock at a specific strike price. So if you're the buyer, that means there must be a seller. So if there's a seller, they have to be the ones who take the other side of that description and actually become the one who must be in the position to accept stock if the long wants to dispose of stock. So even though the term put is synonymous maybe with downside moves, downside for a stock or an ETF, it's also important to keep in mind that there's two sides of the story, buying and selling. We're focusing today on this strategy on being the seller, or what we call the writer. And instead of having a right to obligate as a buyer, once you become a put seller, you are obligated to purchase the underlying shares of either the stock or the ETF at the specific stock price or strike price. And that is only in the case if there's actually an assignment. That is, the long holder said, hey, I'm going to sell, you now must show up and buy. Well, once this trade is executed, where you've gone out done the hard work of identifying a single stock or an ETF that you want to sell a put, write a put, once that trade is actually executed, then you have to look at it from a couple different strategic standpoints. And one of the typical forecasts that a put writer has is that they'd like to see the share prices remain neutral or increase, and also for implied volatility to decrease. The two could stay a little bit mutually exclusive, but overall the best outcome is for the underlying share prices to stay flat or increase, and simultaneously for implied volatility to decrease. But good news as well, we're not going to go into the inner depths of implied volatility. It's just important to remember that all options have a price for a reason. They're reflective of the price of the underlying asset and the time to expiration and the marketplace's expectation of move between today and that actual expiration. So, with that in mind, the best outcome for you as a seller, that is a writer of a put, is that share price remain neutral or increase. So you can actually do a couple different things. You can treat that short put as just a position in your account whereby as it decreases in volume or value, you can buy it back at a lower price. And of course, your profit will be the difference between where you sold that put and where you purchased it. Of course, that's before commissions. Or you can actually, if the underlying share has gone up in value and is above the strike price at expiration, you can let that put option expire worthless and keep that premium, keep it in your pocket. That's a nice reward for having a look-see at a market that you were willing to buy and getting that insurance premium put into your pocket. However, with this strategy, it's important to note that focusing on that other side of the R, risk, is that there's little, if any, protection to the downside. I mean, you're in fact open to substantial risk as a put writer, because if you buy the shares at the strike, you now have risk of that underlying share going all the way to zero. Will it likely happen? No, probably not, but it's always important to know your maximum risk at any time you go into a position. So with the basics out of the way, let's go into the various characteristics of cash-secured puts. And this typically involves what we call selling at the money or out of the money options. And as I mentioned, one of today's goals has been to perhaps put in your artillery another attribute of options terminology, which is what we call moneyness. And moneyness is a designation of at the money or out of the money, or even in the money. But in this case, for this strategy, we're typically looking at saying, hey, if the stock price is here, we might look at selling a put right here, or selling one lower, which would be defined as out of the money. Now, one of the characteristics that's important to know is that assignment, that is your obligation to buy the underlying shares, potentially welcome and desirable. And this is what I refer to as the discount deal. You're getting an ability to buy shares at lower than the market price as defined by the strike at which you sold the put. So if you're an investor that has a pool of assets that might have been in a money market and you're interested in deploying some of those funds, here's another way to deploy cash. And it gets you that really interesting opportunity to buy shares below the current market price. So I like to call this a win-win if your risk-reward ratio matches up. The discount deal, I think, is one of the best entry points for a retail investor when it comes to option strategies. And of course, that money doesn't go to waste. You're going to get interest income on the funds you set aside by your broker. But keep in mind, if you get assigned the underlying shares, that means the put buyer assigned it to you, the put writer, now you're obligated to buy them. You now bear that risk of owning the underlying stock or ETF. But that's an important point here, is that a put selling strategy should really only take place on an underlying stock or ETF that you are willing to hold. Could be in the short term, middle term, or long term, but you are signing up on day one that you sell the put that, hey, I'm willing to take ownership of that underlying share. So what's your motivation of entering into a cash-secured put transaction? Well, a couple things that come to mind, and I like to call these the pillars of an option strategy. So you're looking at perhaps an individual stock or an ETF, and your view, your forecast, is that you see kind of a temporary downturn in the market. But long term, you're likely bullish on the stock or the ETF. How much, over what time, that's something that has to go into your strategy. But what I like the most about this strategy is that the motivation to own the stock or the ETF below the current level is a great discount deal. And that is a great entrance to be able to buy an asset at a discount. So as the picture shows, basically what I've just described is a roller coaster scenario. So does that align with your kind of risk tolerance that, hey, something bad's going to happen in the short term, I want to get a hold of that asset because I think something good's going to happen in the long term? Well, sure. I mean, there's all kinds of events that come up on stocks and ETFs that you can take aware of. There could be event risk in the marketplace, stuff going on, with trade wars. Could be, potential for dividend distributions, that might be, or earnings that come up that you're concerned about, a company missing their earnings from a lot of investment reports that you read, but the company's fundamentally solid for the long term. So there's really only one takeaway question from the cash secured put strategy, and that is, if you picture it as a roller coaster strategy, do you have the desire to buy that underlying share on the potential dip? Only you can answer, but I like this strategy because it gives you a chance to get in, and it gives you a strategy that you can say, I'm sticking to it, and I know where I come out, both in terms of entry, what happens in assignment, and I know my risk. That's important. Always a focus on risk. And that leads us into a little bit more explanation. So I want to just re-emphasize what I said a little bit earlier, is that the shares that you get assigned, they may not just have a sudden, roller coaster, a dip, but they may plummet hard. It could be a really terrible earnings announcement. You could have a drop, 5, 10, 20%, or something could happen, the stock could go to zero. Yeah, some of these are extreme situations, but it's important to think about these things because you need to also think forward as to whether you would have a backup plan, a type of a strategy, what to do. Now, in terms of the risk, a lot of these things depend on a short-term declining share price. As I mentioned, the setup to a longer-term higher share price. But one thing's for sure, puts increase in value as the underlying shares go down. So if you were to sell this put and now there's a plummet in the underlying shares, the value of the put's going to go higher. Let's say you said, look, I can't take it anymore, I want to get out. Your only strategy will be to buy back that put, and you will be buying it back at a higher price level. And of course, that will lead to a cash out-of-the-pocket loss before brokerage commissions. Another area where you could have a negative attribute in terms of risk is that if there's a real sell-off in that underlying share price, that often is reflected in an increase in implied volatility, which will also be reflected in the put price, much higher put price. And that will also basically extract pain or exasperation in terms of your position. Going into it, how much are you willing to lose? You can measure that in terms of buying back the put at a higher level, or once you get assignment, what to do with the shares. And again, the wipeout provision here, shares going to zero, you're buying that strike price times 100 shares that make up the contract specifications, and you're getting nothing in return. That's a tough outcome. But again, those are event risk are far and few in between. But there's another situation here, and I call it the opportunity risk. Is that, let's say the roller coaster down, goes just a tiny bit, but in turn it goes to the right side and it actually starts to go up and up. The shares go up. You now have sold a put. Good news, it's decreasing in value, but the share prices go up so much that they're above the strike price at expiration that you never get that discount deal. You never get a chance at buying that underlying stock or the ETF at the price that you were willing to pay. So you miss out on that buying opportunity altogether. And as the slide says, well, that one got away. In terms of, is that okay for you? Well, for me, this strategy fits my risk-reward profile. I put on a cash secured put this Monday. It was a dip in the stock. I found the out-of-the-money strike that I was comfortable buying the stock with cash that I had in a money market fund. And since then, now that stock has rallied significantly above the strike. So as it stands right now, if the expiration were today, I would not be able to buy that stock. But I do have a nice premium that I've been able to put into my pocket. And in terms of timing, just so you know how I look at this, I always look for options at least 30 days out. That's my sweet spot, 30 to 35 days out. That's where I like to enter into the cash secured put. Couple reasons for that. That's generally when now any type of your time value is going to really start to decrease at a fast rate coming into expiration. But I have a much more simplistic view, and this is coming from my retail investor kind of psyche, is that if I can do the strategy every 30 days, I basically get 12 shots in a year. And it puts me on a calendar. I call it the calendar of options recognition. At the point in the month that I feel that I can put this trade on, I know about 30 days from now I can do it again. Rinse and repeat. So in terms of strategy, this gives you a repeatable strategy throughout the year, one that can be done a considerable amount of time, again, if it's right for risk and reward ratio. So let's dive into an example in terms of mathematically how this would play out. And here's a super simple example of an underlying stock. And our hypothetical trader, Anthony here, he has been viewing a particular stock. We always like to call it stock XYZ, our fantastically phantom stock, that he has seen basically news of a recent and substantial financial settlement. And Anthony expects this particular stock to decline by about 10% with an earnings announcement in a week. But Anthony would love to own the stock if he had to, if he got the opportunity. So he's really long-term bullish. So if there is a potential drop in the shares, he'd be happy to actually to buy. So here's an opportunity to now examine the field of play for stock XYZ, which is currently trading in the market at $100. So Anthony's strategy is to look for an out-of-the-money strike. Remember that term moneyness, out of the money by about 10%. That makes it easy. Look at a strike price of $90. That is paired with the time frame, as I mentioned, a 30-day. So the 30-day $90 put is trading at $1. So upon selling that, the brokerage company is going to say, look, Anthony, you need $8,900 in your account to execute that cash secured short put. So how do you get to that $8,900? Well, it's actually, once again, pretty simple. Look at your strike price of 90. If you take that times, you multiply by 100 shares, that's $9,000. That is, if you were to pay 90 for 100 shares, you'd have to pull out of your pocket $9,000. In this case, you're selling a put and you're putting into your pocket $1, or $1 times 100 shares, $100. So $9,000 out of your pocket, $100 in your pocket. The total cash required for this trade from a brokerage view in case that stock went to zero is $8,900. So the risk reward here is, again, also very simple. Let's say the stock goes up. Your maximum gain on this position is going to be that dollar, or $100 again before brokerage commissions. And it doesn't take into account whether or not you got exercise. It just says, hey, you got $100 in your pocket. That's your maximum reward. And that out-of-pocket cost of $8,900 is also defined as the maximum risk. And that maximum risk equals minimum margin. So on one hand, this particular strategy of cash secured puts may seem like a big margin play. But we like to think of it in terms of a cash deployment play. Do you want to get a discount deal? Are you looking to deploy your cash in a little different way as an alternative form? This strategy gives you that opportunity to do so. And what happens if you get to your break even? You get assigned that stock. Well, your break even is at $89. So that's the $90 strike minus the $1 put premium you took in. So now you know where you can mark to market your daily profit, of course, and loss. And here is what I like to say now. You're able to find out a dollar in, a dollar out. Stock goes up or down, your break-even is $89. So for every $1 up, $100 profit. For every $1 down, it's a $100 loss. Very simple P&L. So let's take a look at it in terms of the risk-reward, well, profit and loss graph. So in terms of mentioning the maximum profit, just to draw your eyes to the center of the page with the blue lines, the tangent going down to your left, and then the hard right turn with the red dot. That's your maximum profit. That's the $100 you get in your pocket. And of course, the blue line going down on the vertical scale, that means your dollar for dollar loss. But if you had been assigned shares, now you are break-even 89, and you can see the green dash line moving higher. That's basically your profit scenario. And of course, if you shift hard to the right and you said, look, what if I just bought the stock at $100? That would be your profit and loss scenario. Dollar for dollar, whether the stock's going down or up. So let's move forward. I think this is straightforward, but let's address what happens at expiration. And this is a key takeaway for those of you who are new to the cash secured put strategy in terms of what happens at expiration. Remember, you entered into this trade, actually Anthony did, selling a 30-day 90 put at $1, and now the stock is below $90. So what happens? Well, that short put gets assigned. The person who bought it says, look, the stock's lower, I'm selling at 90. I want my $90 per share. That means you, as the put writer, are obligated. You must purchase those shares at 90. And you're doing that obviously with cash on hand. That was the full margin in place. And now you look at this position differently. You came in, you sold a put. That was what was on your brokerage statement every time you logged in. And now that put is no longer there. You actually have now a new position, long 100 shares of the XYZ stock. So once you know that your break even on this trade can be calculated at $89, now you can look at where you are in the marketplace of XYZ stock at $100. Here's your discount deal. Would you like to buy your stock at 89 bucks or 11% lower than where the market is now? And for me, I always like to do that. I do it in a little slightly lower percentages, but there's a great example of the discount deal, 11% below the current market price with 30 days to go. Definitely a possibility in terms of single listed stocks and, of course, ETFs. What about the flip side? Let's say XYZ is trading above $90 at expiration. What's going to happen to that short put, that one that you wrote? Well, you know you got that profit of $1 in your hand, but now the stock's higher. The person who bought the put said, "Hey, I got the stock making money. I'm not gonna give it to you at 90. It's way higher." So you don't actually end up with your shares or your stock position. And now you get into that point where I mentioned 12 times a year, if you focus on 30-day puts, you can reevaluate your market outlook and make your next trading decision. It might be with XYZ stock. It might be with any other stock. I like to look at, basically in my strategy, I have about 10 stocks that I feel I would be indifferent to owning at any one time. And I monitor those 10 stocks each month. Which ones are at their highs, which ones have had a pullback, and which ones have earnings coming up. And then I kind of zero in on, here's what I think makes sense for me in terms of a retail investor. That's how I go about making my next trading decision. This strategy always gives you that ability to reset time and time again. So with that in mind, let's go on to the next example for all of you ETF traders out there. So let's imagine in this scenario, our retail investor, Deepesh, he anticipates a temporary market correction followed of 5% followed by a long-term rally. And to capitalize on this forecast, he decides to sell cash secured puts in a broad-based ETF. Let's see. 5% sell-offs, is that reality in the broad market? Well, we've just essentially gone through one the last couple of weeks. Went through one the holiday season leading up to Christmas. So this type of scenario, is definitely, in the marketplace in terms of the rear view lens on an immediate basis. So this is as real of a scenario as you can get. Now, the decision again as to which moneyness in terms of at the money or out of the money strike to put, again, is up to you. This trading example falls in line more with what I like to do, is find those puts which are 5% out of the money. In this case, the underlying ETF trading at $285. The investor, Deepesh, looks to sell an out of the money strike at $271. But this time, he has a little bit of a longer term horizon, 45 days instead of 30 days. So that means there's going to be a little bit more what we call time value in the put. That's okay. Deepesh still wants to own this underlying ETF if the market sells off and really wants to get that additional option premium put in his pocket. So the requirement there is to get one short put, and the cash required out of pocket is going to be $26,945. Okay, how do you come up with that? Very simple. Take the strike of the put of 271 times 100 shares. That would equate to $27,100. Then subtract out of there the actual put that you took in of $1.55 or times 100 shares at $155. So the $27,100 minus $155 comes out to $26,945. That's the amount of cash you need to have out of pocket to enter into this broad-based short put. So let's look at the risk reward, just as we did with XYZ stock. So the stock now is trading at $285, and we're going to sell that 271 put at $155. So the maximum gain in case that ETF takes off and goes up, it's going to be limited to $1.55, $155. Of course, it doesn't take into account whether you got shares of that ETF to be able to hold on to it. So once again, you have to face the maximum risk, the $26,945. Imagine that ETF goes to zero. I think it's hard to imagine because it is hard to imagine, but at least you know what your minimum margin is going to be because it's equal. And of course, all you need to do in terms of finding your break even is take that 271 put, subtract off your premium of $1.55, and now you come out to your break even amount for that ETF of $268.45. That's your bogey. That's your line in the sand. Hey, I'm winning above it. Hey, I'm losing below it. Well, in terms of the profit and loss graph, not so different from what we looked at XYZ stock. Again, just to focus on the blue arrows connected by the red dot. Your maximum profit in this strategy is going to be capped if the stock goes higher. You get that $155 in your account. That's good news. And of course, looking at if you had been assigned those shares of stock, you would have the ability to participate in the upside, which is measured by the green line. But of course, once you have those shares of stock, hey, you're going to the downside. That's why the blue line and the green dotted line are superimposed on each other. So it's a decision you need to make in terms of, hey, do I sell this put now or do I just buy the outright ETF? Well, you can see the risk-reward profile over to the far right with the red dashed line. You're long the ETF dollar for dollar as it increases in value, and importantly, as it decreases in value. So how about where we come out with this ETF if it's below $271 expiration? Remember, we sold, actually Deepesh sold a 45-day 271 put at $1.55. So if that short put is below the strike price, that long holder is going to say, look, I'm selling my ETF shares. You, Deepesh, now have to show up and buy them. You got to put cash on the barrelhead, $27,100. That's fine. Deepesh said, look, I had that money sitting in a money market account. I was looking for an alternative investment deployment of that cash. The cash secured put fit my bill for a discount deal. But now Deepesh has a new risk reward in that long ETF position. But Deepesh knows where the break even is at 269.45. But look at that. More than $15 below where the current market price is. That seems like a great deal. Hey, a market swoons like this, I'm in. Well, let's go on in terms of what happens if ETF price is above 271. Well, again, you come out ahead on this trade, but you come out ahead to the tune of $155. That is before brokerage commissions and fees. And you didn't get that ETF position in your account that you were really hoping to buy, at a big discount. But that's okay. You can now get in the same cat seat as where you were with XYZ stock. Reevaluate the market. All kinds of things going on in the market, from the upcoming budget deal, tariffs on autos, tariffs and trade deals, North American, trade deals with Canada and Mexico. There's plenty of events in the market that will help you assess, your risk-reward tolerance for market moves that may put you into position to deploy the cash-secured put strategy. So all of this is good and well, very simple. But the whole strategy comes down to the strike and expiry selection. And we like to say it's central to the strategy because it's central to your reward risk tolerance levels. And as we discussed a little bit earlier in terms of the options attribute of moneyness, the concept of out of the money is really self-explanatory. It's out of the money, meaning it's way, way away. So with that in mind, when you know your underlying asset price, a stock or an ETF, if you go far away from where it is today and you look to sell a put, your likelihood of that assignment of getting to buy those shares, it's lower, frankly. And also, the value of that put you're going to sell, the premium is going to be lower because the marketplace is discounting the potential, or rather the probability, that it will go to that level or even below that level. Now, there's also another term of moneyness to consider, and as I mentioned before, at the money. You can be too close to where the at the money is to sell a put, or even in the money on a fast-moving stock. And if you really want to buy that underlying stock or ETF, you might be simply better off buying those shares. So from an expiry selection, you have to really get to a place where you're comfortable asking the question, how long will that stock or ETF go? And how long will it take to get to that level? And then importantly, with that roller coaster picture in your mind, you've just gone down to get that underlying share or ETF share, and now you're really you're happy. But will that roller coaster, will that dip turn around now and go to the upside? Will it go sideways, or will it continue to decline? That's part of the risk picture here. Certainly important to examine. And again, everything is centered around assignment. Will your put position that you sold in your account go away, and now you are assigned shares of that ETF or underlying stock, which will show up in your account? So now you're in the position of a fund manager. It's your funds. You decided you were going to move them from money market into this strategy. So now you've got to decide how to manage that position. So now you've got to go through all these what ifs. So let's say you get into a crazy situation where there is a real sell-off at that underlying stock or ETF. You get assigned. Now you got the shares just like you wanted. The strategy was so great when you got into it. That discount deal was irresistible. But now what do? Do you double down and buy more stock? Or do you try and go into some type of a stock repair strategy where you might sell a covered call to try and lower your break even? That covered call has a nice feature now, as that's going to give you some additional income. So there are opportunities, or what we like to call optionality, to repair positions once they've plummeted. But they definitely take research, time, and of course more education at optionseducation.org. Let's look at the The flip side is I touched on in both examples. Let's say the shares never dip and the options expire out of the money. That is, the buyer said, look, I'm not giving you these shares. They've gone up in value. I'm going to keep them. This is that opportunity risk I talked about. You missed out on being able to buy that beloved underlying share class. So do you go out in the market and just bite the bullet and buy shares? I mean, that's one possibility. Or do you now sell another put at what is a higher strike price to take in the premium and reactivate the discount deal all over again? I mean, certainly that is an opportunity. It doesn't prevent the scenario from happening again where the underlying stock or ETF will continue to rally and you never get hold of those shares. So you get the premium, but you lose out on a lot of the upside. I mean, these are decisions that have to be made. And of course, one of the attributes that need to be taken in place is like dividend yield. Am I getting a good dividend from the stock? Would I get a good dividend from the stock? Would I get a good dividend from the ETF? So a lot to think about in terms of this strategy. It's important to know that it doesn't matter what experience level you have as an options investor, whether today is your first experience and you're trying to get your head around how is it I'm buying shares when I'm short a put, that's fine. Optionseducation.org has a wonderful introductory path, and you can follow it, which is called My Path Assessment. Learn at your own pace. Come back again and again. And we have a number of podcasts and videos that are obviously available on demand that help you reinforce ideas so you understand it in terms of what's important to you in terms of risk reward. And of course, just as today is a webinar, we actually have live investor events around the country. We have one coming up in June in New York. We have them in Dallas later on, Los Angeles. So it doesn't matter where you are. If you're local to one of the cities in which we're on the road show, come and spend a morning with us. Hear about a lot of different strategies to help pique your interest on ideas that can add into your investment portfolio.
As Dan had said, definitely visit our website for more information, optionseducation.org. For more information on our services and our webinar program, you can visit our YouTube channel, and definitely keep in touch with us on social media to stay abreast of our upcoming events, both live and online. That's it for today. Dan, thank you so much. A wonderful, wonderful event. And ladies and gentlemen, thank you for joining us. Have a great day, and we'll see you soon. Bye.